What's up, y'all? So today is going to be a fun one. I actually had 3 questions that I was going to be answering for you all. Oh, yeah, before I get started. Hey, guys. Michael Manatskanian, real estate investor with over $22 million of real estate. The majority has been bought leveraging creative financing, buying deals from wholesalers, mastering deal analysis, and then raising funds from other investors and people that just want to either get high interest return on their money or co-own assets with me. So we actually own the real estate together. With all that being said, the things I really specialize in is analyzing deals. I love the co-living or rent by the room management strategy, both because we're providing affordable housing and we get really great returns as investors. And I coach the super investors community where I teach them how to do exactly the same. Typically, that's designed for more intermediate or experienced investors looking to level up with more advanced strategies. But if you are newer in the real estate space, I have the free Wealth the Real Estate community for you. Let me drop the link in the comments. So if you would like, you can always hop into that. Boom. You're always welcome joining there if you want. Free access to deal analysis calculators if you want. Free videos on training. And well, you know what? Let's stop talking about it. Let's start showing about it. Let's share screen. Boom. So let me show you right here. Clean this up. I was going to clean this up, but let's see. All right, so this is the free Wealth the Real Estate community. You come in, awesome. You sign up. We have almost 1,000 members. I'm not actively pushing this or encouraging people to join outside of these calls. I just want to provide as much value as I can to those that are here. We have a community forum board where you can ask any and all questions. I do my best to answer them. That tends to be what we answer during these calls. There's a classroom, so I provide you literally a start here section to get you started, but really a preview to super investors. So this is really for you to understand your financial freedom goals and your numbers. This is pretty in-depth and detailed, including my entire journey to real estate investing up until this point. I have a bunch of tools and resources. So it's a budget and financial freedom tracker for you, free creative real estate investment calculator you can utilize to analyze deals. I have a different one, a paid version that I have for my super investors community, but this is the foundation of that calculator. You can analyze any and all creative finance deals that way. Plus, if you're analyzing creative deals, here's a checklist of all the information you need. This one is going to be relevant. So let me open up a copy for later because I'm going to be analyzing a deal with my friend, Eddie Charger, in just a few minutes. It's a co-living investment opportunity that we're going to look at, see if it's one that we want to actually buy. There's trainings on how to traditionally invest in real estate, how to creatively invest in real estate, and how to analyze deals. Essentially, this is really focused on deal analysis and why real estate investing is so imperative if your goal is to quickly and efficiently achieve financial freedom. If you want to do it slower, but less time and effort, put your money in the stock market. I'm all for that. I have money in the stock market, but I didn't want to wait 45 years to have $3 million to potentially retire with. I wanted to be financially free as early as I could, which meant I was going to work harder, which meant I became financially free in less than 5 years. So with all that being said, let me grab, so we have a copy of the creative deal analysis checklist, which we're going to be using. And then I'm going to need a copy of the paid calculator. So this is the super investors community, a little bit different, a lot more high level. We go into literally everything and anything you could ever want to get into. Let me get rid of that. So this is the super investors community. Once again, this is more for you're already a real estate investor. Maybe you do traditional financing. Maybe you've never done creative deals. Maybe you've never bought from wholesalers. Maybe you've never used other people's money. You've only used your own. That's what this community is, to help you level up and be financially free much more quickly and efficiently. Plus all the tools and resources that I use in my business, all the systems, operations, strategy sessions, consultations, helping you guys out, CRM access. You guys get access to the exact same CRM that I use, all of it. You get literally all of it. I give you every tool and resource that I use to fast track your journey to financial freedom. All right. So with that being said, let's go to super deal analysis. And this is no freaking joke. I mean, when I say I'm pretty good at educating, this is no joke what we have going on in here for the education. I just need to grab a copy of the boom. All right. Excellent. So let me bring on my friend, Eddie, who's in the audience. Hey, Eddie, how you doing, brother? Oh, we can't hear you. You got to You gotta mute yourself.
What about now? Can you hear me?
Yeah, we can hear you now. We can hear you a little bit.
Is there a lot of? I'm like at a local Starbucks. I wasn't gonna make it home, so I
Are
was
you
like,
sure
let
you're
me
not at a
just
party? It sounds like there is it's
little
vibing out there is what
rave
it sounds
music
like.
going on in the back. But I mean,
Okay.
if push comes to shove, I could just go into the car.
Yeah, and I mean, you did send me all the information we need to analyze the deal. So if
Perfect.
push comes to shove, I can also just analyze this thing to the best of my ability with the information you provided.
Yeah.
That shouldn't be too hard as well.
Okay.
So first and foremost, we're going to go into the creative deal analysis checklist. You're more than welcome to mute yourself for now, and then just unmute if I ask you stuff. Does that sound good? Cool, brother. Let's do that. And let me zoom in for you all, make it real nice and easy to see. So the creative deal analysis checklist, I give it to my community, the super investors, but I also give it for free to anyone who wants to analyze deals and know what information do I need to be able to analyze a deal. Eddie did an excellent job of first analyzing this deal and then providing me all the information I needed. So I'm going to take this stuff. I'll put this. I'm not going to put the full address on here. Eddie and I are working this deal actively right now. It's already like we're ready to close on, or ready to put this thing under contract today. I'm not worried about you guys stealing it. If you want to be that guy, you could be that guy. We're not really worried about it, but you just won't be in our circle anymore. That's not the sub 2 way. That's not the way we do business. But if you want to steal it, go for it. The agent's going to work with us anyway. So, but we'll make sure to ask your name. Just kidding. So 6 bed, 2.5 bath. I will put a note that since we're going co-living, Eddie's already looked at it to see what size we think we can get it to. We think we get it to an 8 bed, 3 bath co-living opportunity. Property square foot. Look at this bad boy right here. 2522. That's a big old house. We have the photos. I'll pull that up here. We won't look at it quite yet, but I'll pull that up after and we can look at it to understand. This one is not under contract yet, right? And the purchase price that's already in his spreadsheet that he analyzed. And I'm going to really go into this in detail and analyze myself. You did a great job here, Eddie, by the way. Just to clarify, 265, 764. That sounds right? Okay, perfect.
Yep.
That means then I'm good with everything else.
Hey, I also want to say something. So
please.
I tuned into your community to be able to make sure I knew what I was doing. So all the underwriting stuff that I did was because of somebody that came out of your community and walked me through the whole thing.
That's incredible. So not only is it me, because I try to provide as much value as I can through these calls, through all the trainings and all this stuff I put out there for free. No one could ever say I'm not giving the Hermosi or Pace effect of tons of free value and education. But then even my community are just such freaking go-givers. These are not just super investors. They are super freaking helpers and people helping other people out on their journey to financial freedom. So that is sick. And if you guys don't know Eddie, Eddie is a freaking baller, sub 2 leader in Georgia, Atlanta. We just hosted an event, a meetup. I flew out to one of my properties. Eddie and I checked out a couple of our properties that we have down there, did some walkthrough, some content, ate at Waffle House, and then hosted a meetup with over 50 plus people. We just invited to one of the properties for free, 7 bed, 5 bath, I believe, something like that. Kitchen plus kitchenette, 2 washer dryers, all this good stuff. Showed around the house, explained how we found the deal, renovated it, all the numbers in detail. And then we shared that live as well. Eddie live streamed the whole thing on his Instagram. I've got the recordings, which we'll put up. We have a lot of it on whatever. It's like the goal is to help as many people achieve financial freedom. If we can be any part of your journey to financial freedom, that's all we care about. Some people are really concerned about stacking money and like their goal is like, okay, I got $1 million. How do I get $1.5 million? How do I get 2? How do I get 10? I don't care about that. My metric is how many people can I help? Am I making a bunch of money along the way? Yeah, that's why I have the time and energy and effort to be able to do this stuff, right? I'm financially free at 30 years old, but I'm not going to stop working. And my real metric is how many of you all can I help on your investing journey? So me, my community, the free community, people like Eddie, all these leaders, a lot of people out there are trying to do the exact same thing. And that's why I'm not worried about people snaking a deal or whatever, because that's not, if someone does that and tries to do something like that, well, you're just not the right fit for us anyway. And we won't work with you. In that, I guess a little bit of info, people have tried to snake deals just like this one right in real time. And that is what it is. That's on them. So with all that being said, Eddie, 265, 764, is that the sub 2 loan amount as well? Because it's a hybrid deal, correct? Or is this?
This would be straight sub 2.
Okay. So the loan amount for sub 2, and you have that, so 265, 764. Excellent. And then so there is 20K cash to seller. Is that correct? Or what is that down payment of 20?
So the 20K is, so majority of it's going directly to the seller, but it's trying to get the seller out of the bad situation. So they currently have 6K in bankruptcy that they need to pay off. They have 10K in arrears, COVID relief that they got to pay off. And then they needed some moving expenses. So previously they were going to get $4,000 for moving expenses. However, they went ahead and jumped the gun and got a lease over in Houston that they're currently paying for. So they have 6K that they got to put on that. So they actually need 10K cash instead of the 4K that was talked about.
So it's supposed to be 4K originally,
right?
But now 10K. Okay, so this is really good because a lot of times I'm analyzing deals that are already under contract with the terms defined. This is the different end of it. When you're like Eddie doing the active deal negotiation, let's say the wholesaler, right? You're not wholesaling, but you're direct to the seller and agent structuring it before it's under contract. Things are very dynamic. So usually I'm negotiating either in this when I'm direct to seller agent or after the terms are defined and then analyzing it and then seeing how we can renegotiate it. This one's good because you see the reality of it all. So 4K originally, but now 10K. So in reality, the entry costs are 16 plus 10, right? So 26K. And I'm not saying we're going to pay them that. I'm going to say, let's analyze this deal and see if it's worth paying them that. And then the 265, 764, that is the loan amount.
That's the loan amount. Yeah.
So in my opinion, when we do this, when we say let me zoom into the calculator. When we say this is 265, what did I say it was? 265, 764. This down payment is 26. We're just going to overwrite it. We don't need the percent. Who cares? If you want to know what the percent is, equal 26,000. So equals this divided by our backslash the purchase price. And in my opinion, the purchase price is actually the down payment plus the sub 2 loan amount, right? So I count these fees that go to the seller or an agent or whatever as part of this purchase price in reality. Even though we may just say this is a fee paid to the seller, or a fee as part of the entry costs, in reality, the purchase price is really the money to the seller and the money to the money that we're taking over, like the sub 2 loan, and then whatever's left over is seller finance. So equals 26 plus 265, 764. And this number, because if this is the purchase price, 291, 764, and this is the amount of the sub 2 loan, this is how much we're paying the down payment, there's nothing left over to seller finance. That's why this automatically goes to 0. These numbers are irrelevant now. We can send this to 0. It doesn't really matter what we do. Well, we could leave that. It doesn't really matter what we do because there's no seller finance. And now let me look at your monthly PITI that you put together. Is the number, oh, okay, perfect. So you did it. You already recreated the loan. I don't need to go on PropStream, one of my favorite tools, to recreate this loan. Well, actually, I will go on PropStream real quick and show you guys how we got these numbers. 3.12%, 30, 12, 31, 21. And that's saying the monthly loan payment is $12,1901. So if I take this address and I go to PropStream and I log in to PropStream. So if you do not have PropStream yet, please use the link in my bio. I give you a free trial. I think you get like 7 days, maybe even longer. I think this month you also get like $50 of credits to pull information on sellers and leads and all that stuff. If you want to do that, I give you a free trial in the link in my bio. If you don't want to, or in the description of this video. So if you don't want to do that, you don't have to do that. But all right, so we're going to look up the details. So we're going to see right here, they have an FHA loan of $284,747. Did you know about the second loan? Maybe it's a down payment assistance loan.
Yeah, it's a down payment assistance loan. Yep.
Okay. So $284,747, that's the loan amount. And that's exactly what Eddie had here in his spreadsheet right here. The interest rate is not on PropStream. They estimate the interest rate based on the time, right? But they don't know specifically the interest rate. Eddie confirmed with the seller, probably either with the agent or seller, and confirmed the a mortgage statement, or they just told you the value. I mean, if they lied and then we find out later, we're going to change the terms. So
yeah, Basically what I did is I got them to tell me exactly what it is, but I also had the agent send me a recent copy of the mortgage statement.
Perfect.
So that showed us that the interest rate was 3.125.
Perfect. So let me change that to 3.125. And then this rounds, you could just add another decimal if you need to, right? Just click this little thing to add a decimal. And then the first payment date. So PropStream will give you that. It says the loan is due January 1st, 2052. The best assumption is the first payment was made 30 years prior because the loan term is 360. It was made 30 years prior to that. So January 1st, 2022 is when you can assume 12/31/2021, January 1st, 2022. Doesn't really matter. I'm going to put 1/1/2022. And on the mortgage statement, it'll tell you the maturity date typically. So you'll know from there, you know, if it's off by a month, it really doesn't matter. That matters. It doesn't change anything here for the monthly loan payment it's calculating. It changes the amortization schedule. Basically, when was the first payment made? And then 30, and then like, what is the principal and interest? This doesn't even affect it. It just changes it like slightly by the day of when this loan started and when you're taking over. Where are you taking over at, right? So if we took it over April 1st, this would be the loan amount. It's really irrelevant if it's off by a month or two, but you want to get a rough idea so you know when the loan is due in full. The older the sub 2 loan, the better, because you're further in the amortization schedule. As you go down and you pay more and more payments, right? The first payment, 741 of the 1219 went towards interest, 478 went towards principal. Well, let's say 10 years in, well, 586 goes towards interest, 633 goes towards principal. It's still the same payment, but more is going towards principal and less is going towards interest. And that is shown right here in this chart, essentially. Your loan payment is always the same on a fixed loan, but the interest, the amount going towards interest is going down over time, and the amount going towards principal is going up over time. This point where it converts, where more is going towards principal than interest, is like the inflection point, or the conversion, like the inflection point of when more is going towards principal versus the interest. So I just want to show you that the further you come into a loan, the more you're paying towards principal, less towards interest. And the lower the interest rate, the sooner this inflection point occurs. All right, let's get back to is there a balloon on this one?
No balloon.
Cool. So this is all irrelevant. We don't even need to put a date, whatever. You can just disregard this whole thing, essentially, is what we're doing here. All right. So the 1219.79 is, let's just talk about this real fast. The down payment assistance, is there a payment there, or is it just paid off when you sell the property?
Just paid off when you sell the property, from my understanding of it. I wasn't too worried about it because I saw it was only $100 per month. But based off of what she's been paying off our PITI, it's not included. So okay. It's one of the things that just get paid off. My
bigger concern is this $13,700 going to be owed when we purchase the property, or is it going to be paid off when the house is sold in the future? Because technically it is being sold to a new buyer, even though the loan stays in place. So that's a question to consider when you look at the loan documents, because that can potentially mean another $13,700 roughly that's going to be paid at closing. More than likely, if that's paid at closing and you weren't anticipating that, that means less money to the seller if that's all that works for your so getting more information on that would be great. All right. So that's kind of the end of what we need PropStream for right now. From the mortgage statement, right? So we know the monthly loan payment is $1,219.79. Do you know what the actual PITI is?
The actual PITI is $19.94.12.
Okay, so PITI, $19.94.12. So this PITI with this loan, actually it's a FHA loan. So that means the escrow account, you're paying your principal and interest on the loan, which is this $1,219.79. Then you have your taxes and insurance is part of that's the TI that you're also paying as part of your mortgage payment. And then because it's an FHA loan, and there's property mortgage insurance because you put a lower down payment or use a loan product like an FHA loan, then there's also PMI payments, and that also needs to be accounted for. Do you have the breakdown of that from the mortgage statement?
I do. Hold on a second.
So the escrow amount, the month that's going towards these three things, equals $19.94 minus $1,219, $774.33 each month is going towards property mortgage insurance, taxes, and insurance. Just general like hazard property insurance, right? Property mortgage insurance is for a lower down payment, not the same thing as hazard insurance. And if you want to send that over, I can also take a look if that's beneficial. If you want to email me in that same email, I won't put their mortgage statement on here, but because I don't see that in your analysis, but it might have been accounted for anyway. It was accounted for between your tax and insurance. And even if we don't know that amount, it doesn't really matter at the end of the day. Because we just know the monthly amount is this. We can just add that, whether you add it to taxes, insurance, PMI, it doesn't really matter. It's all getting spent either way here. Should equal to 774, except for
what you're saying is exactly correct. So what we did was we found out what the PI was,
and
then I just double checked what taxes were, and then also what insurance was going to be, and then just backtracked it off of the yearly into that monthly rate.
So what the insurance would be with new insurance, or what the insurance would be with their current insurance?
With the current insurance was.
Okay, and then you just included your PMI, it looks like, in those numbers. So correct. I can show you guys real quickly. Let's go to PropStream again, and let's go to tax information. Recently, they were assessed at 122, 160. Now, let's go to, this is where? What's the county? Let's go to Decatur, DeKalb County. So, DeKalb County property taxes. And then what we're going to do, not now. You can just search this right away. What they most recently paid. No exemptions, ignore that. They might have had exemptions, but view and pay property tax online. So every single site, every single county is a little bit different. But usually if you get their website and you get the parcel number, just put that in. Oh, with spaces instead of dashes. Okay. I'm going to search that. Here we go. Whoops. What did I just do? Let me go back one. Okay. This is the property. This is the address, 3947. Excellent. So they were billed for 2024, 4223.64, and they paid that in full for 2024. Let's see what it was assessed at, or we can actually pull up the actual statement. So it was assessed at 123,120. Let's see if there were any exemptions, because the property is worth 307,800 is what they estimated it's worth. So we're buying it for less than that, which is great. If we buy it for more than that, we can anticipate our tax will go up. If we buy it for less than that, even if they say it's worth more, we can say, hey, no, we bought it for this lower amount. Okay. So we don't have to worry about taxes necessarily going up. This is one of those where we're buying it at a price less than it was previously appraised at, which is great for us, which means the taxes are probably going to be the same as long as there's no exemptions. So the way they do it is they take 40% assessment, and that's the number here. And then they charge you this millage rate for these different things. And that's what this is. So we can just estimate the same amount of taxes this year, because it's not like the property has gone up in value, or we're not buying it for a higher value than that. So 4223.64 is what was 2024. If you want to add an extra $50 just in case it goes up, you can definitely do that. So I'm going to take that. I'm going to put the annual amount there. And that's $352 a month there. That's exactly what you did as well. I see that. That's exactly what you did, Eddie. Yep. And then for insurance, you put the rest as 422. I would say some of that is PMI. We can set $200 of that to PMI. I don't know exactly what it is on this amount. It's going to be based on a few factors. It doesn't really matter. What we're going to do is say 200. So we're going to put here, PMI is 200. Taxes is equals this value. So then whatever is left over equals 774 minus 33 minus PMI minus taxes. 222.36 is basically what they're paying in insurance, assuming the PMI is correct. So because I do the annual, right? It's pink for annual. You're filling in the annual. You just do 2.36 times 12, and that is right. That's the monthly right there, right? We could have put the number here and then change this to be times 12. I just fill in the annual. If this is wrong, it's okay, because the same payment is still there. And what I would do is I'd add an extra buffer of maybe $100, because taxes might go up and insurance might go up. So this can be, especially if we're doing rent by the room, tax buffer. $100 is fairly reasonable because that's an extra $1,200 they're going to add towards like this. If this goes up, if you look at their previous payments, well, this one has gone up a lot, but really it's because it was probably assessed massively higher. 305. And then let's see this one. I think the millage rates is what went up. No, so it was appraised at 271 in 2022, then 305, and then 307. So if it jumped that much between here to here, between 23 and 24, either there was exemptions that were removed, or no, it's still the same owner. Still the same owner, so probably not the exemptions. It's probably the millage rate is what went up. So millage rate 0.4379. So here, millage rate is basically saying whatever the taxable assessment value is times this is what you're going to pay in taxes. That's all the calculation is. And they do have an exemption of 490.57. Look at that. Mm-hmm. Do they lose that? No, they still have that. So actually our taxes will go up because they have exemptions that we will not have exemptions for. I don't know what they are in this particular example. It's not really worth looking at. We just have to add this to the taxes, if that makes sense.
Yeah.
So 489.45. Okay, change to an equal. So taxes, insurance, PMI, and then we have this buffer. We're not going to worry about the long-term rental paying any utilities, and that's why I'm kind of restructuring my calculator moving forward at some point. What we're going to do now is look at the pad split, because how much time do we have? It's 12. Yeah, so we got 30 more minutes. Let me look at the entry cost and the pad split, and we'll come back and fill in the dots on long-term rental and all that if we need to.
Okay.
This information. What was that?
One thing about the entry cost, the entry is the fee to the agent.
Mm-hmm.
Even though this isn't on market, she is being represented by an agent, and she's helping her out. So it's $5,000 to the agent.
Cool.
And then there's a wholesaler who originally had this deal and could not figure out how to be able to put it all together. And so we're paying that wholesaler $5,000 for bringing the deal and learning how to do this.
Okay. And then we'll set the cleaning, rehab, and furnishing. We're going to set this one to 0. We're going to add that to the pad split section.
Yeah.
Okay. And then the closing costs, we'll just keep it at 2% for now. Hopefully it's less. I account for, so this is transaction coordination costs, LLC formation costs, and inspection. Roughly it's going to be around $3,500. So I just keep that in there. Okay. And then carrying costs, just reserves, 3 months of reserves based on these expenses. However, we'll adjust that based on the numbers we get as a co-living rental. So then all you really have to do now is go down to the pad split. We're going rent by the room is all we're looking at. And in your opinion, you said we're going to add 2 more bedrooms. And what I estimate typically is $6,500 a bedroom and then $1,500 per total bedroom. So there's 2 here plus, oh, whoops, I didn't add that here. So we said it was a 5, 2.5. Right. So that's where this comes in, right? You had this information. Oh, 6, 2.5.
Yeah, 6, 2.5.
6, 2.5 said. So you then like this is the easier thing to fill out, and then you transfer to the spreadsheet. I use the spreadsheet so frequently, I could just fill it in real time. But for most people, it's better to do this until you get comfortable, then putting it in the right spots. Because it's easier to like checklist that essentially. All right, so all these numbers broke, but it won't in 1 second. So this all breaks because this only puts in a value if the number of shared and private bathrooms is accurate compared to the number of bedrooms added plus the beds that were already there. So this needs to equal 8. Otherwise, this will not work. So what you have is based on your layout of the property, you say 1 will have a private bathroom and 7 will be shared bathrooms. So 1 will have the private, and then the other 7 bedrooms will share the 2 bathrooms, correct?
Correct.
And then how do you go from 2.5 to 3 bathrooms? Is there a possibility to easily expand that? Or are you just accounting for that as 3? Or are you budgeting for that?
Yeah, we wanted to budget for it because it's a split level, and downstairs actually has 2 of the bedrooms. And so
actually there are photos here, which is great, even though it's not on market yet. So these might be the last ones, but this will give us a great idea of inside.
So downstairs they have that right there.
Is this a bedroom?
No.
Will this be a bedroom in your mind?
That will be a bedroom. Yeah.
I would agree. This too, or is this like a hallway?
It's just a different angle.
Oh, it's the same room. Oh, I see.
Yeah.
Oh, yeah. Good. So that's easy. And it looks like, is there a way to access the rest of the house without this doorway?
Yes. So that's the bottom level. So if you go through that doorway is where you get to the other two rooms that share that half bath.
But will they be able to access from the kitchen, or do they have to go down through here to go there?
They would have to go through there.
So we'd have to create this into a hallway.
Correct. Yeah.
Okay. Or figure out another option, but that just starts becoming more costly and structural. This is the half?
That's the half, I believe.
And there's space to add a stand-up shower somewhere?
I believe so, but I couldn't tell from that angle. I have to go visit the property.
Okay. And so that'll be next. Okay. Because even if it's not, I mean, 1.5 baths shared by, that's kind of tough. 1.5 baths shared by 7.
Yeah.
Okay, let's keep looking. So this one's a full. This one's probably maybe the master. I don't know. And then where's the second bedroom? Where'd you anticipate that going?
So the second bedroom is upstairs on the other side of the kitchen is a dining room.
Oh, okay. This or this? Yeah, with a chandelier. Okay, cool.
Yeah. So now that area. So there's two chandeliers. The one on the bottom, and so
this one.
That one is the room. The one that you see up top is like the little. No. Sorry, scroll up a little bit.
This one. This one's part of the kitchen, basically.
That's part of the kitchen, correct.
I would leave this one. It's too tight and it's too close to any. Exactly. So this one stays. This one would be a dining room.
That's the common area.
My concern is this right here. How do they get from here to here?
So that's another thing, though. When you scroll further down, that other room is the living room. So that also could be a bedroom. So
okay, so that's why it's good. You're gonna go check out the property.
Yep.
Because that photo or video, like people ask me, how do I know? Well, we do the best we can with photos. Sometimes you have a layout, not this one, but sometimes you have like a layout, a floor plan, which makes it a lot easier. Mm-hmm. But going to see the property, sending contractors out, boots on the ground is the way that you find out. Because a property could be 2,500 square feet and have a hard time putting in, it says 3.5 bath. That would be even better.
Yeah, it says 3.5 bath, but we also have video footage of it. We had the agent send us video footage, and when I went through it, it's only 2.5 bath. But for whatever reason on MLS, it lists as 3 bath, full baths, and a half bath, which is.
Well, let's see what it says. Split level. And this is the sucky part. Everything's like different, so it's like we're having to look. Oh, property appraisal information. No, we haven't got nothing. And PropStream is just going to pull exactly what the MLS says anyway. So that's where they're going to get their data. So it's kind of disingenuous anyway. I mean, like it's not, they just don't know, right?
Yeah, they just don't know. But the agent verified it with the video as well. Okay.
All right, cool. So let's get back to it. We're going to do 2-bed. We'll just stick with this. I'm going to add that 10,000 here that you had before to just in case for that bathroom, to have a buffer for that renovation cost. Okay. And then next what we're going to do, let me move this all the way here. What next we're going to do is we're going to pull up pad split to see what the rental income is. I see you have 262 and 171. Let's verify this information. So we have the address 30304 Decatur. And if you guys are not familiar with it yet, you need to have a pad split account. If you do not have a pad split account, you literally cannot underwrite co-living deals well. I mean, you're going to do it and it's going to be really inefficient. So let me drop that in the comments. Give me 1 second. Let me drop that in here for you. Comments. Okay, so there's that. That's PadSplit. If you want a free account on PadSplit, there you go. And then the only other thing I could think of is, yeah. So sorry, I know I had 4 questions to answer. We're not going to answer those this week, which is fine. This is way more fun, I think. So we're going to put, oh, let's get the address again. I'm going to take us right there. All right, there's Decatur, and it's 3034. 30034.
It's gonna be on the bottom side.
Oh, right here. Thank you. Oh, good. So there's 329 active units. That's good. It's not like it's tiny. 0 upcoming, so there's no new ones. They say 94% average occupancy, 3 days to first booking. These are stellar numbers. These are incredible numbers. This is great. The thing is, the zip code is so big, and it is not like downtown-ish area. So there could be a lot of variability depending on like how close you are to the highway and all that stuff. This is when, if we like this, then we talk to my rep, Blake Lewis, at PadSplit. That link also gets you connected to my rep at PadSplit, Blake Lewis. You set up a time with her on her calendar to run you through all this stuff. We're going to do the initial analysis right now with these numbers. And then what we're going to do is talk to Blake after to go street by street. Like, hey, I know these properties, how much do they rent for? And then these ones, depending on where we're at on the street, it's going to matter. And if I showed you, so there's 156 right here. So it's just north of this 156. So like here, basically. I don't know where here, but it's, oh wait, this is 155. And if you guys are familiar with watching me in any of these videos, I'm literally terrible at looking at maps. It's like my greatest weakness. 285. Especially because I don't know every market. I think it's here, whatever. It's somewhere here. And all right, I cannot settle like that. Sorry, guys. Wesley Chapel. Oh, yeah, it is 155. I was being blind. Wesley Chapel Road. Boring.
It's going to be right over there.
Right here. So it's like right in this area.
Yeah.
So it's not too far from the highway, but it is further away. Like I would assume properties here rent for more than properties here, and they rent faster just because it's closer to the city center. That's always my assumption, is that city centers rent for more than non-city centers. But that's where talking to the rep, like this is good info to move forward with. Go check out the property, potentially even put it under contract, understanding your earnest money deposit can or cannot be refundable, right? It depends on how you structure it. But then you work with your rep to say, okay, like, what are we getting from really specific numbers here? What if all of them are up here and there's literally nothing here, or everything here is the 6% vacancy? We don't know until we talk to the rep. So there's information you get from the zip code, and then you move forward with the rep there to get a much better understanding of the actual numbers. All right, so we said it was 171, 262. I'd even put these maybe as lower because there's more shared baths. But what another great thing you can do, well, let's put the average occupancy. So even though it says 6% for vacancy, or no, it says 94% average occupancy, which means it's vacant 6% of the time. What I do in that scenario is I'm always putting at least 8% minimum, because that means 1 month of the year it's vacant. Okay. So I never go less than 8%, even if it like, but if it's at like 80% average occupancy, that's 20% vacancy, right? 100 minus 80 is 20. I'd put 80% occupancy. But if it's less than 8% vacancy, I'm always going to put at least 8. Maintenance and CapEx, we'll talk about that. So then our PadSplit management fee, basically that's what PadSplit charges. In reality, this is like the worst the first year, and then it's better. If you look at their fee model, they collect, when a new tenant moves in, they collect 100% of the income for the first 10 days. And then after that, it's 8% of the income. Let's swap these two. And then it's 8% of the income afterwards. Because you're like leasing everything up in the first year, you're going to have a much higher management fee from them because that first 10 days that they collect, and then it stabilizes over time. And then usually if you have property management separate from using PadSplit, a lot of people self-manage. We self-manage, but like in-house in our business, and we charge 5% for that. Depending on who you're working with, they will charge more or less, or you do it yourself and you keep that management fee. It's pretty easy to self-manage once you have your your like Rolodex of contractors and handymen and cleaners and all that set up, and you're leveraging the pad split platform. And then so vacancy and then maintenance and CapEx. So I will say that for maintenance and CapEx, the 10% that you typically do for a long-term rental, I no longer do. I think that's too excessive because saving almost $8,000 in reserves for a property is pretty excessive. What I would do is go at least the minimum of what it would be. Like I would do 10% of the long-term rental income and then add a little bit to that. I don't think you need 10% of $6,322, but I also don't think I think that this I think you put 2,100 is what your long-term rental income was. So that 10% is $210. In my opinion, you should go to around 1.5 times this amount. So 15% of this is roughly what you should be saving in maintenance and CapEx. So 315. So here, that's probably close to 5%. So like 5% is kind of the number that I go to now primarily for what I would set for maintenance and CapEx for a pad split because the income is so much higher. As it is a percentage of the income, just because you're doing pad split or rent by the room versus rent long-term rental doesn't mean the roof needs to be replaced more frequently or that the appliances will go out like maybe a little bit more frequently, but it's not that much more intensive. So just putting it as like 1.5 times or 15% of the long-term rental or just 5% of the maintenance and CapEx to account for the additional maintenance, right? There is going to be more maintenance. There's going to be more people using the bathrooms and things like that. There's going to be more maintenance issues, but the capital expenditures, you don't really need to account for that full amount, right? Hopefully that makes sense. So that's kind of where I'm going with the 5% of the pad split income as opposed to the 10% that is traditional for a long-term rental. It just is like literally unnecessary. I've never had to use that. Operating properties that are since 2023 in the co-living model, this is much more in alignment with what is accurate as opposed to the 10% of this $6,000 of income. You're still setting aside almost $4,000 for maintenance and CapEx, which is solid.
This is great, yeah.
And this is pretty much in alignment with your info. Obviously, I'm a little bit more conservative than you. I had the vacancy a little bit higher. Actually, we have the same vacancy. The real big difference is the maintenance and CapEx, and then I account for more entry costs than you do.
Yeah.
And that was just basically the carrying costs, the reserves, plus the admin reimbursement costs. One thing I would do is probably increase this a little bit to have a little bit more reserves, in my opinion. I would probably set this to maybe 5 months, get closer to $10,000 just sitting in your war chest for this new property because it's rent by the room. It's going to take some time to stabilize. You're going to have plus or minus on the furnishings by a little bit, plus or minus a little bit on the renovations. We do have $10K for rehab here already just for the bathroom, which is probably on the high end. And this by the bed and furnishings is kind of more on the high end, but I would rather slightly overraise and have more money in reserves than underraise and like try to scramble, like, how are we going to fund this thing?
Exactly.
So in this type of deal where you're already getting really solid returns, you're already getting solid cash flow and cash on cash return. As long as you can add the 2 bedrooms and the bathroom, right? We're going to get a contractor to go out there and give us a real quote, not just this estimations on a spreadsheet. And we're going to get more refined income data from Blake on the private bathroom and the shared bathroom. This is going to be really, like, once we refine all that, we'll get a much clearer idea on what we need. But doing a pad split with the acquisitions, the renovations and furnishings, and the reserves under 100K is solid, especially if you're generating over $1,700 a month. If you're generating over $1,000 a month, that's great. If you're doing over $1,500 a month or $1,700 a month, that's a solid return. And that means when we go to raise money, we can either use a private money lender here and say, hey, we'll pay you 12%, we'll pay you quarterly, and we will still profit over $900, or they will get $900 a month in payments. And we'll keep $882 without giving up any ownership. Or if you're familiar with the way I like to buy deals with private money partners, you can raise this money from one partner. And because it's such solid returns, you can give maybe a 30% split, and they're getting what's really in line with my capital partners, 7% cash on cash return, and the ROI is close to 15%. So the 7%, we're saying our private money partner brings in $90,910. That's the acquisition costs, the renovation and furnishing costs, and the reserves. They're bringing in all that money with even a little bit excess in reserves. They're going to get 30% ownership and 30% cash flow, leaving them $6,447 a month in total cash flow, or total cash flow for the year, not month, for the year. And then between debt pay down, property appreciation, and interest payments, their 30% portion of that, they're getting a 13.8% total return on investment. It's accounting for everything. And when you just account for the cash flow divided by the entry cost, they're getting 7%, which is really solid when you're talking about you get this in cash flow, cash on cash return, 7%, and you get ownership benefits pushing you closer to 13%. That's really solid on a deal. I think we can provide this to a partner that would be very happy to buy this with us, fund it for 30% ownership and cash flow for 90K or 91K. Like what I do then is I hard code to the nearest round number. So 91K is what they would put in to then get these returns and be a partner, not just a lender, but to be a partner and own this asset with us. Or we can go the PML route, which is totally fine as well. Once again, 9,100 was what I would do. It just is a little bit more complexity there. That's why this super calculator is freaking incredible, because it's not only are you analyzing this deal immediately, you can then almost automatically with like a tiny click of a button determine what can you pay your partners. And then if you're going to raise money from a partner, you say, hey, partner, let's zoom in a little bit more. Maybe we can zoom in a tiny bit more. This is if you want to be a partner on this deal, these are your returns. This is your 1 year, 5 year, and 10-year return, your cash on cash and your return on investment. Like this is your analysis. You say that we're raising 91,000 or 90,910. 45,000 is going towards the acquisition. 35 is going towards rehab and furnishings. And we're setting aside 10,675 in reserves. You can even articulate, we already went a little bit overestimate on the rehab and furnishings. Whatever's extra is also going to reserves, which is incredible because once you have a certain amount of money left in your reserves, let's say 10, 15, 20, I like to say once we have $20,000 in reserves for a property, everything in excess, we don't need to set aside 5% a month for reserves. Yep. If it's already at 20K, you're not going to need more than that typically for something situation that comes up. What you do is you take that excess and now you pay that out as cash flow to all the owners, all the partners. And that is incredible because now the returns that you're anticipating, well, now it's much higher. And you still have 20,000 in reserves. So having reserves up front already helps you get to that point much sooner.
Yep.
So I wouldn't try to negotiate too much. I would really, I still think the entry, like the acquisition, in my opinion, is fairly high. Like when you see when we're adding 91,000 roughly to a property worth less than 300, that's a very high entry. Understanding that the majority is, or like half of it's going towards, let's see. Roughly half of it is going towards, exactly half of that is going towards rehab, furnishings, and reserves. I still think this is fairly high. This 45,000 that's going towards down payment to seller, agent commissions, rehab, furnishing, or closing costs, admin reimbursement costs, and assignment fee. I think it'd be worth trying to reduce this to the best of your ability. Even though we're going to get solid returns, we're also taking more risk because this thing does not perform well at all as a long-term rental. It loses money as well. Does it lose money? I'm almost certain it loses money.
It'll lose money over time for sure.
Barely cash flow neutral as a long-term rental. Like barely cash flow neutral. Well, this can actually go down to 10. It's like slightly like a tiny. Oh no, actually it is losing money as a long-term rental. Because you can see that here, if you just go from pad split to long-term rental, you'll see the income minus expenses minus management minus reserves, you're losing $600 as a long-term rental when you account for management and reserves as well, which I would always account for that. I'm okay with that risk. I have a higher risk tolerance. I'm fine losing maybe at most up to $1,000 a month as a long-term rental, as long as it's not in an HOA area and it's a great co-living property that generates over $1,000 a month in cash flow. The higher it generates, the more risk I'm willing to take as a loss as a long-term rental. That's not for everyone. Everyone has a different risk tolerance. That's my recommendation because you're not going to find very many profitable long-term rentals, creative financing or not, in today's market. It's just hard. So if you want to actually be financially free, you might have to take a little bit more risk, but understand the benefit is that you're going to get almost $2,000 a month in cash flow. So, either sit on the sidelines or take some investments. Like this is an investment at the end of the day. All right. With all that being said, let me shift this back to pad split. See all the numbers here. So pad split, we have our numbers here. Our long-term analysis here accounts for all that stuff. So 23.6% cash on cash, 46.2% total return on investment when you account for all these other things. I think it's a great deal as is, but I would see what we can do about them continually adding to this. I don't think they deserve $26,000. I don't think the property is worth so much that it's worth paying them that much because it's not a great long-term rental. The interest rate is great, which is awesome. That's good. It's a great interest rate. But between the agent commission, the assignment fee, and the seller, I would personally try to reduce this a little bit. Like I would try to reduce this a little bit to get this closer to 15% for our partners at 30%. So what I would do is I would just take, let's say 11K off here, and it may not work for them, but I would take 11K off here and then see what that looks like. Whoops, did that not update? Oh, because I hard coded this amount. Whoops. So let's go back a little bit to where I hard coded this. All right.
There you go.
So changing this to 15,000. See what that does to the numbers. So now our partners are getting 15.8%, 8.1% cash on cash return. In theory, you could actually drop this maybe to 25%. I wouldn't. I would keep it at that 30 because I would rather give a little bit more to my partner. We have partners that have less ownership, but the better the deal, the lower their ownership, right? Because like the better the deal itself does, they get a smaller percentage of that for that same amount of money. That's why it's important to have your deal analysis and then figure out what your partners get. I would leave it at this for the partner because this would be pretty easy to fund. These are solid returns. So by just dropping this by 11K or saying, okay, maybe it's 20K instead of 26, that's still pretty solid. And that's saving everyone a little bit of money. We're compromising. They wanted 26. It sounds like originally they wanted 10K, and then there's 6K to this bankruptcy payment, 10K in arrears. Like you're already paying back their mortgage. They're going to lose this property foreclosure. And then we're paying, you catch them up for this bankruptcy, which is this 6K is honestly money here, right? That's money to them that they're going to pay, right? It's not because of arrears. So you're paying them $20,000 and they're already $10,000 behind on a mortgage. I'm all happy to like help people out in situations. But at the end of the day, it's like kind of illogical. Even if the deal makes sense, it's like illogical to give someone 20K when they're going to lose this property to foreclosure anyway. And you're paying the agent, you're paying the wholesale, you're paying all these people to then buy a deal that only works as a great co-living, but not really any other management strategy. It's got to make sense for us and our partners and for the seller as well. It may or may not make sense, but I would think if you can drop this and say, hey, you want a 4K, but now you want 10K. Is this 6K included in this 10K or no?
No, it's not included. And what you're saying right now is such a good point. And this is what people have to understand when you're negotiating. You have to find out what is it that the seller needs, because if you don't have these extra pieces of information, you're really just making blind offers and you're not able to really help the seller in their situation, right? But because we know, like, hey, if you don't do this, what's the other options, right? You can either lose the home or they have an option that they're thinking, well, maybe we'll just try to list it. Now you're just gambling, right? Now you're just rolling dice and trying to see if it works. And the crazy part is, even if you list it, because we ran the numbers, what's the seller net? What are you going to get as once you pay everything off? You're probably going to get less than what we're offering you now. So understanding what they need and how to help them is truly how you're able to make an offer. If you're just throwing numbers out thinking you're doing something, two things are going to happen. Either one, you're going to lose the deal because you're not making sense to them, or two, you'll overpay for the deal, which depending on your strategy, there's nothing wrong with that if everything goes perfect. But this is real estate, right?
Let me ask you this, Eddie. Did you run the ARV on this? Do you think it's actually worth close to 380, 360? Because that's where they could be getting their money from. I mean, if that's the case, if we think it's actually worth close to that, then I would say everything I said was kind of moot, because we are walking into equity, which then we're just paying for that equity. That would make sense, because otherwise, if it was really worth 381 and they listed it, they would get more than this, not much more, but they would get more than this, but they're going to spend a lot of time and energy. I mean, that's if they don't lose the property foreclosure. That's if
and they don't have, but that's the thing. They don't have the time either, right? This isn't a scenario where they can just be like, hey, let's try it for 90 days. Right. She has to move. They're already in forbearance. So
they're already paying rent on another property. They're in forbearance. They've already, and one thing we forgot to mention again is we're taking on another $14,000 of debt that may or may not need to get paid. Understanding this is going to make a big difference too. Is this going to get paid up front, or is this going to get paid at the end of whenever this is officially sold in the future?
Yeah.
Because I don't know if it's attached to this loan, which means as long as this loan stays in place, we're fine. If it's attached to the property, which then means we're going to probably have to pay this 13,000 that we weren't anticipating. And that would definitely change your numbers when you add another, let's just put it here, another 13,500. Oops. I'm always heavy handed with my zeros. So then that means your cash on cash went from 23 to 20. It's still good, right? It's still good, especially if we're walking into equity. But whatever equity we thought we had at 380, and we're buying it at 291, and then we're paying all these fees, and then we have this 13.5. Like, we're just adding and adding whatever equity we thought was worth paying them for. It's like, well, it's not worth it. And that's where it comes in. Like, the science of analyzing in real estate is also like, there's like an art to it as well. There's no like perfect right. You're not going to just say, okay, your ARV minus this, minus this, minus this. You're going to have this perfect answer every time. It's, what do you feel is worthwhile based on the numbers and the returns you get? What feels like it makes sense for you? I would say this feels like it's too much based on the risk of this 13.5, the fact that they're in foreclosure, the fact that they're getting a lot of money, and the only caveat is they might have equity that we're taking over. So that could,
Yeah.
Cool. All right. So do me a favor, check out the property, see how many bedrooms we can add, see if the bathroom is logical, see if we add that bedroom, is that hallway reasonable? We need to research and see about this 13,669. When is that going to be due? Is that going to be due right away or not? It looks like it's just attached to, because it was like 1 year after. It's just going to be paid off at that time, but it might be paid off when it's sold. Very important to verify that. And then, otherwise we're chilling. I mean, I think this will be our co-living deal together.
Perfect. Let's do it. First of many.
Yes, sir. All right, cool. All right. Well, I'm going to leave it at that. If there were any questions, I did not see them. Okay, cool. All right. Thank you, LaShawn. LaShawn said few nuggets. Excellent. Excellent. All right, y'all. Thank you. If you are not yet connected, please, I'm dropping the. Thank you, Martha. Martha said, first time jumping in, been in Owners Club. I'm also in Owners Club. She's now in Sub 2. Just joined Sub 2 last night. Looking forward to learning more. Thank you, Martha. I appreciate you. And actually, Martha is a partner with me on the $2.2 million co-living portfolio that we bought in Georgia, the ones that we were just at, Eddie.
Nice.
Let me say, if you want to learn how to do this stuff and you are a real estate investor that's looking to get better at analyzing deals, buying deals from wholesalers, creative financing, capital raising, doing everything that I do with all my systems, tools, resources, everything, I just dropped the Super Investors community. It's on School. We crushed it. We grew it so fast with little to no marketing. I won something called the School Games. I spent a day with Hermosi because of that. It's an awesome community of actual investors looking to scale up. If you are still starting out or you don't have the money to potentially join something like that, no worries. That's why I provide you the free wealth through real estate community on School, right? All that I shared with you at the very beginning, all the links are in the description. I want to help you out any way that I can, whether you're ready to scale or you're just starting out or just need to refine some of your skill set. I'm here to help you guys. If you like Eddie, are here to help you. So Eddie, what's the best way for people to connect with you?
For sure. Definitely. You can reach out to me on Instagram. It's at Eddie, EDDY, Charger, CHARGER. And if you have any deals that you have questions on or you need help discussing or talking to an agent or what may have you, a seller, creative finance is my bread and butter. So you can also email me at deals, DEALS, with charger@gmail.com.
Deals with charger@gmail.com. Boom, I got it all right here. Put it on the screen, dropped it in a comment.
Perfect.
So you got both. Oh, I didn't space it, so excuse that. But all right, y'all. Thank you. Have a great rest of your week. Super Investors, I will see you tonight for an awesome How to Be the CEO of Your Real Estate Business mastermind training tonight. So
that's a good one.
Love you guys. Peace.